it would be great to talk about overtrading. And I think this is something that we've covered kind of briefly in some of the previous segments, but we haven't spent a good amount of time of thinking about why overtrading might happen and what the impact of that is. And so I think when we're thinking about highly volatile periods, what you tend to see is that humans have something called an action bias, which is this idea that like when stuff is happening, you desperately want to react. You've got to react, you've got to respond, and doing something that is less active and more passive feels really wrong. It feels like, oh no, I'm not reacting to this information, like the world is like, I'm shutting my eyes. And so the side effect of that is that you tend to trade a lot during volatile periods. And there's a lot of good and bad reasons why you might do that. There might be more opportunities that you see that you want to exploit. But at the same time, our body and our brain are actually pushing us to trade more. And it's pushing us to trade more for a few reasons. Number one, when you have highly volatile periods, what happens in periods of stress to your body, Rich? Acute stress.
Heart rate.
Heart rate, yeah.
Yeah. Adrenaline.
Yes. So it's so adrenaline is it's what is largely thought of in psychology terms as a resource mobilization hormone. So essentially what is happening is your body is getting ready to mobilize resources to stuff that is going to help you, exactly like you say, fight or flight. And that involves having a bit of a, very practical things. Your vision goes from very, very wide to much narrower so that you can focus on the thing that's in front of you. Yeah, physically, like your field of view literally narrows.
Wow.
That's one thing that happens. Another thing that happens is blood starts circulating to your extremities, because when you want to run or when you want to fight, you want those parts of your body to be highly oxygenated. And so where is the blood coming from? It's coming from your brain. And so that then...
Not ideal.
Right, well, yeah, exactly. And so one of the things that results in is we trigger what psychologists sometimes call fast and frugal decision-making, which is where your brain is ready to make decisions really quickly, but those decisions can be subject to bias. Okay. And so if you've got this kind of more like a bias in your physical body towards action, and your brain is more subject to those biases, what you'll tend to see is that in like more stressful periods, you will want to do stuff, and not doing stuff feels really bad. And I think people struggle to understand that actually not making a decision is a decision.
Yeah, absolutely.
And so the result of that is you tend to see lots of people trading at a higher frequency than they might even want to take advantage of new information in that high intensity trading environment.
But also we've got to discuss what high vol does. Yeah. What does high volatility actually have an effect on whipping people in and out?
Yeah.
Because derivatives desks are chasing.
For sure. And I think chasing is like a very common side effect of this action bias, because when you're looking to do something, what do you tend to do? You tend to do one of three things. Is you tend to trim your winners, because you're scared and you want to do something to them. You tend to open up positions in assets that you don't typically trade in. And then the third thing is you tend to chase momentum, and you like kind of FOMO into positions because you don't want to miss out on opportunity. And part of the reason of why all of that is bad is actually because also people, this is something we spoke about last week, people underestimate the value of optionality when it comes to holding a bit of cash. And that's because the kinds of things you might do with that cash are hypothetical, versus the trade in front of you is real. And it feels really useful, it feels much more real, right? And it feels
keeping the powder dry.
Exactly, yeah. And so I think what you tend to see is that like you tend to do a lot of momentum chasing, and that actually gets worse, especially if you're looking at very momentum driven markets like we have at the moment, or if you're looking at options where not only is realized vol going up, implied vol is going up. And then you might be buying options at a time where options are really expensive.
Yeah.
And like that might be a painful decision. And so I think you tend to see in moments like this a bit of a bias towards trading really, really high volumes. And that might not necessarily be unprofitable, because there's so many opportunities to exploit dislocations in the market right now, but it does tend to lead to worse quality decisions on a trade by trade basis.
What about investing versus trading?
Yeah.
You know, is this a time to have your shopping list, and you know Rolls Royce at £5.50 is something that you should be.
Yeah, I mean, like now is a good time to be kind of greedy while others are fearful, right? And that's not true of all equities. Like actually, if you look at some of the valuations you see, some of them are still pretty rich, but actually there are lots of them that are a really good price. And I'm trying to do a little bit of like shopping to work out like what are the names that honestly I've been looking to buy even at previous prices, but now are at kind of a 10 to 20% discount. And so, but that decision-making process needs to be slow and deliberate and thoughtful.
Not when the adrenaline is.
Exactly, right? And so then that's where a lot of the systems we normally talk about around trying to think about what your thesis is, or writing a trading journal, or talking to another human being about what some of the trades are, all of those actually only become more important in more intense volatile periods where the opportunity for investment is high and the risk with overtrading is also high. And so then you just have to really force yourself to try and be thoughtful and deliberate about what your approach is going to be.
Excellent. Isar, very, very useful, because it is, you know, a lot of people are going to be watching at home at the moment, seeing the market go up through 5,000, having traded 48.
I know, right? Like days
hours ago?
Yeah, hours ago.
2 hours ago.
Yeah, exactly. Well, we were nearly at, what was the low? It was like 47?
47.91.
Yeah, which is mad.
Yeah. But you see that, and you see that momentum going through, and then you've got to remember that derivatives desks have huge open exposure, and they're generally short gamma.
Yeah, they normally have negative gamma. Yeah.
So just run us through really quick 30 seconds on short gamma and why it's making these moves.
So the difference between a derivatives desk and me as someone who's just a retail derivatives trader is I don't have to hedge my positions, whereas a derivatives desk that is selling options or even buying options needs to hedge their exposure. And so when you have negative gamma, basically what that means is as the price goes up, by hedging, they need to sell the underlying equity or whatever asset they're buying. And as the price goes down, they need to buy the underlying to hedge.
Positive gamma.
Sorry. Yes, exactly. Yeah, exactly. And so what
That's
you...
a good thing.
Yeah, exactly. Well, and so what you tend to find is when you have negative gamma in dealer positions, it tends to be a stabilizing influence on the spot price. And so what you tend to see is that like a lot of these large options desks that have huge amounts of options exposure in notional terms are acting as a stabilizer for the market until you break out of those bounds where they go from negative gamma to positive gamma, at which case then it tends to be a destabilizing influence.
Because you have to buy as the market goes through the highs, and you have to sell as the market goes through the low. So that's the negative gamma.
Yeah, exactly.
And that effect really is what's causing this.
And that's where you can get some of those whipsaws, and actually why you might tend to see trading within certain corridors over the course of the day. And also why, if you look at right in the last maybe 10 minutes of the day, as a lot of those options are expiring.
Last half hour. Oh.
I know, right? And you see then huge moves because then suddenly dealers don't have to hedge as much because a bunch of those options are expiring.